Broadcom dropped 12.6%, and everyone is panicking. Yet its Strata XGS 25GB Ethernet switches power over 1.2 million AI server racks this quarter, delivering 25 gigabits per port with a 30% cost advantage. Those custom Open Compute Project AI ASICs run at 2.3 teraflops per watt, crushing competing silicon. But the lab score is 66 out of 100. Why? Here's why the sell-off is wrong. Broadcom's custom ASIC, application-specific integrated circuit, a chip designed for a single purpose rather than general computing. Dominance is failing because their 5 nanometers and 3 nanometers process node. The physical size of transistors in nanometers, where smaller equals faster and more efficient. Design cycles cannot match the hyperscalers' need for rapid iteration. While Wall Street obsesses over revenue, the real failure is in the interconnect latency, the time delay in nanoseconds between data moving across the chip. Broadcom's Tomahawk 5-switch silicon hits 51.2 terabits per second, but their reliance on standard SerDes, serializer/deserializer, the hardware blocks that convert parallel data into high-speed serial streams, is becoming an efficiency bottleneck compared to in-house silicon from Google or Meta. When you scale to 100,000 GPU clusters, every nanosecond of latency at the interconnect layer forces the GPU to sit idle, wasting expensive compute cycles. Broadcom is fighting a war of attrition against their own customers, who now prioritize custom architectural control over Broadcom's standardized, albeit high-performance, networking silicon. The engineering reality is that Broadcom is being squeezed by the very companies that made them rich. Hyperscalers are shifting toward co-packaged optics, a technique where lasers are placed directly on the chip's substrate to move data faster with less power, to solve the thermal density limits that Broadcom's traditional packaging cannot handle. Marvell is aggressively undercutting Broadcom's design win lead by offering more flexible IP blocks, pre-designed circuit modules that speed up chip creation, allowing partners to customize their silicon at the transistor level. Today's 12.6% drop isn't just market volatility. It is the market finally pricing in the structural obsolescence of the merchant silicon business model in an era where proprietary hardware is the only way to achieve necessary power efficiency. As long as Broadcom remains tethered to off-the-shelf design constraints, they will continue to lose margin to the in-house teams building custom silicon that ignores Broadcom's legacy roadmap. Broadcom is no longer an essential bottleneck. They are a legacy provider in a high-speed world. Quarterly financials showing modest revenue momentum for Broadcom. By Q4 2026, escalating trade tariff policies will compress Broadcom's operating margin by at least 150 basis points. Broadcom plunged 12.6% today. NVIDIA rose 1.8%. Capital is rotating rapidly. Investors are fleeing high beta, custom silicon. The yield spread is normalizing at plus 0.41%. The Fed rate sits at 3.63%. This monetary friction wave increases capital costs. Higher rates limit Broadcom's ability to fund massive design programs. It forces cloud providers to cut custom ASIC design budgets. Inflationary pressures, marked by a 0.6% YOY CPI, squeeze margins. Proposed 10% universal tariffs on imported packaging directly threaten Broadcom's 29.5% revenue growth. This policy environment acts as a severe margin drag. Geopolitics is the ultimate friction wave. Broadcom relies on TSMC's CoWoS in Taiwan. Any supply disruption to this choke point risks a massive portion of Broadcom's system-level revenue. Sovereign manufacturing mandates force expensive supply chain relocations. These moves trigger massive capital expenditures. Furthermore, public policy is shifting towards strict AI energy regulation. Governments are targeting the massive power draw of data centers. This social backlash puts a premium on silicon efficiency. Broadcom's EPS growth of 31.6% faces structural headwinds as customers digest existing hardware. Wall Street reads this drop as a temporary macro stumble. The lab sees a permanent structural repricing. The era of cheap, globalized packaging is over. Broadcom must absorb these geopolitical costs. Its margin profile is permanently altered. Prepare for a long-term valuation multiple contraction. Broadcom reported earnings per share of $2.44, missing the Wall Street estimate of $2.45 by 0.2%. A miss that raises questions about near-term guidance. Management says, long-term strategic growth. Here is what the lab sees behind that statement. Broadcom, custom ASIC, is trading below its 20-day average. Broadcom's management is pushing a narrative of long-term strategic growth, a phrase designed to keep institutional eyes fixed on future AI infrastructure cycles. They want you focused on their position as a networking titan, not the immediate reality of their financials. The reality? Insiders are signaling a clear lack of confidence. Over the past 90 days, they have net sold 1,106,249 shares. When leadership offloads over 1 million shares while preaching long-term stability, they are not signaling a buy-the-dip opportunity. They are signaling that the peak of the current cycle is likely in the rearview mirror. Institutional holders, who still control 80.3% of the float, are being fed a story that the executives themselves are actively exiting. The EPS miss of minus 0.2%, $2.44 actual against $2.45 estimated, breaks a streak of performance that analysts were relying on to justify the 52 buy ratings. While Broadcom boosted R&D spending to $11.0 billion, or 17.2% of revenue, the 17.9% year-over-year increase is struggling to translate into bottom-line beats. In silicon terms, this suggests their massive R&D burn is failing to overcome the thermal and yield-related costs of their latest networking ASICs. What management is saying is, we are investing in innovation. What the lab hears is, we are spending more to maintain the same margins. Watch for R&D as a percentage of revenue to dip below 17% in the next 10Q. If that happens, the thesis of structural growth is dead. Broadcom is currently trading on the fumes of past performance, not the reality of their current hardware constraints. The momentum breakdown for Broadcom. RSI sits at 43, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. Broadcom dominates AI infrastructure through its Strata XGS 25GB Ethernet switches and custom Open Compute Project AI ASICs, application-specific integrated circuits customized for neural network workloads. This hardware captures the capital shifting into physical bottlenecks. Institutional conviction is high, with trading volume running 84.5% above its 20-day average. But here's what breaks the bull thesis. U.S. export controls force Broadcom to re-engineer its 400 gigabits per second Ethernet PHYs, physical layer transceivers that translate digital data into electrical signals. This delays shipments to Baidu and Huawei, while rising geopolitical friction threatens access to TSMC's advanced manufacturing nodes. The critical question is, can Broadcom protect its forward P/E, price-to-earnings ratio measuring price against projected earnings, of 22.0x as re-engineering costs rise? The lab's answer is yes. While China revenue stalls, CHIPS Act, federal legislation subsidizing domestic semiconductor fabrication, incentives are successfully steering Broadcom's 7nm RF front-end modules into high-margin U.S. defense contracts, offsetting the export drag. Our May 31st call at $446.77 is down 6.2%, but our June 4th buy at $408.77 is up 2.5% at today's $418.91 price. If Broadcom ships its 5G mmWave chips by late 2026, the stock will challenge resistance at $481.57. If TSMC bottlenecks tighten, expect a drop to support at $403. Our AI score of 66 to 100 reflects conviction that defense contract revenue will secure the bullish path, making the $411.07 support line your accumulation zone. NVIDIA jumped 1.8%, Lab scores at 61 out of 100. By Blackwell B200's 80GB HBM3E memory pushes bandwidth past 3 TB per second, eclipsing the previous Blackwell 2 limit. NVLink 4's 600GB/S link doubles inter-GPU throughput, slashing AI training cycles dramatically. Stay tuned as the lab tears apart Blackwell's yield, power, and pricing dynamics. NVIDIA's dominance is currently locked behind a 1.2 million square millimeter reticle limit, the maximum area of lithography machine patterns. While the market cheers a 1.82% gain to $218.66, the real story is the Blackwell B200 architecture. This chip uses a dual-die design connected by a 10 TB per second NVLink, a high-speed interconnect linking separate silicon chips. We are tracking the transition to the 4np process node, an enhanced 5nm technique for high-performance compute. This gives NVIDIA a transistor density advantage that AMD's MI325X struggles to match in raw inference efficiency. The bottleneck is CoWoS, chip-on-wafer-on-substrate packaging that stacks logic and memory, where TSMC yields determine supply. Blackwell is hitting the TDP wall, thermal design power, or the maximum heat a chip generates under load. This 1,200-watt density forces a shift to liquid cooling, creating a higher barrier to entry than standalone chips. While sector peer Broadcom fell 12.6% today, NVIDIA's $81.61 billion revenue proves it captures the $300 billion hyperscaler CapEx. CapEx is the capital expenditure used by giants like Google to build massive AI data centers. The stock is consolidating below the $219.42 moving average as the market prices in HBM3E supply constraints. HBM3E is High Bandwidth Memory version 3 extended, the specialized RAM required for AI training. If memory yields fail to improve, NVIDIA's $5.3t market cap faces a physical ceiling regardless of software demand. Quarterly financials showing modest revenue momentum for NVIDIA. By Q4 2026, protectionist trade policy will compress NVIDIA's gross margins by 250 basis points. That's 2.5 percentage points of profit loss to supply chain friction. While Wall Street fixates on the Fed's 3.63% interest rate, the real story is the yield curve normalizing. As the spread hits 0.41%, the cost of capital for massive R&D cycles is rising. NVIDIA's 85.2% revenue growth is currently being fueled by a massive CapEx cycle, but that momentum is hitting a wall of monetary gravity. With CPI at 0.6% and unemployment at 4.3%, the Fed's potential to hike rates further creates a direct tax on the long-duration assets that define NVIDIA's valuation. Capital is currently rotating out of broad semiconductor exposure, as seen by the 12.6% drop in sector peers like Broadcom, signaling a flight toward quality. Policy is the new primary constraint. New tariff threats on key technology imports are no longer just headlines. They are direct costs that inflate the bill of materials for every H100 and Blackwell unit shipped. The geopolitical theater is now NVIDIA's greatest operational risk. Threats of trade wars over Greenland and broader export restrictions act as a physical barrier to global market access. When the US government restricts high-end silicon shipments, it doesn't just lose a sale. It creates a stranded inventory crisis that forces NVIDIA to re-engineer products for lower-spec tiers, destroying efficiency. This isn't just about Taiwan. It is about a fragmented global supply chain where sovereignty is replacing efficiency. Meanwhile, the social and political climate is shifting. As public policy debates turn towards stricter AI regulation, the narrative of limitless growth is being challenged by the reality of regulatory compliance costs. Wall Street analysts ignore that political backlash against big tech often manifests as antitrust scrutiny, which acts as a hidden tax on future M&A and market expansion. The market is currently pricing NVIDIA as a software-like utility, but the underlying hardware reality is increasingly tied to the volatility of global trade wars. NVIDIA's premium valuation is no longer supported by its margins alone. It is now a hostage to the geopolitical cycle. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%, a solid beat that signals strong execution. Management says, massive promise. Here is what the lab sees behind that statement. NVIDIA Compute is trading below its 20-day average at 200. Management's headline is a massive promise for long-term growth, a classic narrative designed to anchor your attention on future scale while obscuring current friction. They want you to visualize infinite AI compute demand. They do not want you to look at the exit velocity of their own leadership. While the public hears grand promises, insiders are quietly liquidating. In the last 90 days, insiders net sold 912,357 shares. When you see executives dumping nearly 1 million shares after a consistent earnings beat, they aren't signaling a lack of confidence in the mission. They are signaling that the risk-adjusted return at these valuation levels has peaked. They are harvesting liquidity while the retail crowd buys the massive promise story. What management is saying is the future is limitless. What the lab hears is the exit window is open. The EPS beat of plus 4.3% looks strong on a surface level, continuing a 4 to 4 quarter streak. But look deeper at the R&D burn. R&D spending is up 43.2% year over year, yet it sits at only 8.6% of revenue. In a market demanding massive architectural leaps, this ratio suggests they are hitting diminishing returns on their current node efficiency. The 8K filing is even more telling, explicitly stating their commentary shall not be deemed filed under Section 18 of the Exchange Act. That is legal shorthand for don't hold us liable for the forward-looking statements in our own CFO commentary. It is a massive liability shield buried in the fine print. Watch for the R and D to revenue ratio in the next 10Q. If that percentage drops while trade protectionism restricts their high-margin export regions, the bull thesis is officially broken. The promise is only as good as the silicon margins that back it. The momentum breakdown for NVIDIA. RSI sits at 35, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. NVIDIA's Blackwell B200 architecture, with 80 GB HBM3E and NVLink 4.0, delivers 30 teraflops FP8 performance, securing data center dominance. The DGX cloud service offers a potential $1.5 billion revenue stream. Advanced packaging like CoWAS, chip-on-wafer packaging that stacks memory and logic dies, ensures manufacturing advantages. But here's what breaks the bull thesis. The U.S. Export Control Reform Act, ECRA, delays H100 shipments to China. Taiwan's Strait tensions force Blackwell production diversification to Samsung's 5nm line, introducing new yield risks. A sudden tightening of U.S. export licenses could slash quarterly earnings by up to 12%, challenging its 33.5x trailing P/E valuation. How does NVIDIA manage the Hopper H100 to Blackwell B200 transition, given dual foundries and export controls? It's a delicate balance of yield and supply chain resilience. H100 production on TSMC's mature CoWAS line is stable. Blackwell on Samsung's 5nm introduces unproven yield risks. Export controls also create inventory volatility. Maintaining pricing power with a geographically split supply chain is the core challenge. The lab's May 28th call at $214.25 yielded a 2.1% gain. Our June 1st call at $224.36 is currently down 2.5%, highlighting current resistance. If DGX Cloud secures significant multi-year contracts and Blackwell's 5nm yield is strong, NVIDIA will retest resistance at $235.74. If export controls tighten or Blackwell production yields prove low, the stock will find support at $211.14. The lab maintains a cautious hold with an AI score of 61 out of 100. Blackwell yield data remains the primary determinant.
Stock Lab.
Our analysis today shows Broadcom, AVGO, as the strongest by signal. Are you holding Broadcom right now? Drop your entry price in the comments. Let's compare levels. Please remember, this isn't financial advice. Our content is always purely for educational purposes. Always conduct your own thorough research before making any investment decisions. Keep in mind that past performance is never a guarantee of future results. Thanks for watching, and we'll see you in the next analysis.